Coming up on market shares, Fubo TV filing a lawsuit against the major players that are planning to launch a joint sports streaming venture later this year.
And big companies across the U.S. have made 2024 the year of cost cuts.
And Wall Street's reaction to mega earnings by NVIDIA, how the chipmaker is single-handedly sending the market soaring. Hold on to your wallets because market share starts right now. Good afternoon and welcome to Market Shares. I'm Bradley Hoppenstein.
And I'm Peyton Spellacy. We got a lot to talk about today with NVIDIA specifically.
Yeah. NVIDIA is sending the markets soaring this week, but we have a few things we want to get to before that. Staying in kind of the tech sector, Amazon is paying almost $2 million to migrant contract workers to settle claims of human rights abuses. So in a post yesterday, the company said it hired a third-party labor rights expert to investigate conditions in two of its Saudi Arabia warehouses. A number of practices that violate Amazon's supply chain standard were found.
Amazon's labor record has been heavily scrutinized in recent years. Lawmakers, politicians, and advocacy groups have zeroed in on its treatment of warehouse and delivery workers, arguing that they're exposed to unsafe working conditions. The company has disputed regulators' allegations and say that they continue to invest in worker safety.
All right, let's quickly go to the healthcare sector, or at least Walgreens is actually getting the boot from the Dow, and Amazon is taking its place. So the e-commerce giant is joining the likes of Apple and Disney that make up the 30 stock index. And in a statement by the Dow, the change is intended to reflect the, quote, evolving nature of the American economy by increasing the Dow's consumer retail exposure. Now, once the change is complete, Amazon will rank at 17 out of the 30 stocks on the index. After the announcement, Amazon stock rose around 1%, while Walgreens dropped about 3%.
And we're going to kick it off with our first AI story of the day. Google is pausing the image generation feature of its AI intelligence tool Gemini after the model refused to create images of white people. The company apologized on Wednesday after users noticed that Gemini was creating inaccurate historical images. When the AI was asked to show a picture of a white person, Gemini was told it could not fulfill the request because it, quote, reinforces harmful stereotypes and generalizations about people based on their race, end quote. This incident is yet another setback for Google as it races to take on OpenAI and other players in the competitive AI field.
Yeah, Peyton, that's a story we're going to have to continue to follow. I saw some people on Twitter trying to break the algorithm, try to figure out why it was doing these kind of racist images, but we're going to have to see how Google addresses that in the future. Staying in the tech sector, Palo Alto Networks is lowering its outlook on the year. They beat expectations on both the top and bottom lines, but shares took a 19% nosedive earlier this week after the cybersecurity firm beat earnings, but that year-over-year revenue growth was slower than expected. Net income was about $1.7 billion, bless you, compared to $84 million in the same quarter last year. So big growth, but not quite at the rate the company was hoping for. Palo Alto's CEO says the lowered guidance is a shift in strategy as they look to accelerate growth, mainly through AI, our favorite topic here.
Now, Bradley, this is one of the bigger stories today. NVIDIA is crushing it and AI chip demand is through the roof. That's the shortest version of the story. Now, one of the most valuable U.S. companies, the chip maker, is taking Wall Street by storm, and shares just continue to go up. $22 billion in NVIDIA's fiscal fourth quarter earnings. That's up 265% from a year ago. And net income during the fourth quarter is up $769 billion from last year. Nearly $13 billion compared to about $1.5 billion last year. The stock is an absolute tank right now. And all this was enough to send NVIDIA's market cap to a short-lived $2 trillion this morning. Only Apple and Microsoft have higher valuations right now. NVIDIA has almost created an industry of within its own with this AI chip game. Think about this, though. It took the company 24 years to reach a $1 trillion valuation. Thanks to the AI revolution, though, only 8 months to hit its second trillion.
Wow, that is incredible. I think NVIDIA is single-handedly the most impressive stock through up to this point on the year. Warner Brothers Discovery shares dropped 12% as the company missed estimates on the top and bottom line. The company's fourth quarter net loss was $400 million, or about 16 cents a share. Warner Bros. Also saw its studio's network and advertising revenue fall as the impacts of the Hollywood strikes lingered into the end of the year. There was a silver lining, though, Peyton. Its streaming service Max ended 2023 profitable for the first time, a bit of a trend we're seeing in the streaming sector.
Now, Bradley, if you're checking a bag for an American Airlines flight, you're gonna expect to pay some more. The carrier has announced that it is raising its checked bag fees by $10 from $30 to $40 for bags checked at the airport. For luggage checked online, though, on American's website, the fee is increasing from $30 to $35. This announcement is part of an effort to nudge passengers to become American Airlines status members, as customers who sign up will continue to receive complimentary bags on flights.
It's unbelievable. These airlines play all kinds of games all the time. Like, they can't keep getting away with this. Let's go to home sales now. Sales of previously owned homes rose around 3% to start the year, and this was boosted by lower mortgage rates in November and December. Now those mortgage rates are ticking back up, and the number of homes for sale in January was actually up compared to last year, but still a 3-month low. So this dynamic between buyers and sellers is why the market is still seeing pressure on home prices, but the average price of a home in January was up around 5% from year to year. So we're still kind of seeing inflation play into a lot of different pieces of the economy, Peyton.
And Bradley, this is a story that we've been following. We talked about it a little bit last week. The U.S. sports betting industry previously projected 2023 to be the first 12-figure year. That expectation was a little bit too modest. The American Gaming Association said that the sports betting business finished with a record number of around $120 billion, a whopping 28% increase from 2022. The full year increase is due to several factors. 5 new jurisdictions became operational in 2023, as well as the arrival of ESPN Bet. Future growth at this rate, however, could be hard to come by as states are continuing to show resistance toward legalizing sports betting. Yeah, we talked about it last week with ESPN Bet. We're going to see how they stack up against the bigger players in the sports gambling industry. Boeing, though, can't seem to stay out of headlines. The head of the company's 737 MAX division is leaving in a shakeup weeks after a door panel flew off an Alaska Airlines flight. So following a string of other issues, the manufacturer is pushing out the leader of that division. They made the announcement on Wednesday that Ed Clark, who's been with the company for nearly 18 years, he's done. Someone has to take the fall for all these issues with the 737s. Clark was in charge of overseeing the factory where the final assembly took place for those aircrafts involved in last month's accident. The general manager of the 737 program is going to take over Clark's position. So maybe Boeing getting back on their feet here, Peyton. Yeah, Bradley, I'm shocked that's still happening. And the largest U.S. retailer, Walmart, has agreed to purchase TV maker Vizio. Walmart will acquire the company for over $2 billion, or around $12 a share. Walmart has been a major seller of Vizio devices, but in this move, the retailer giant hopes to boost its ad business and push for higher profits in order to compete with other sellers, such as Amazon. Following the purchase, Vizio shares spiked 16%. Smart move for Walmart. I honestly thought they owned Vizio already. So just a few weeks after ESPN, Fox, and Warner announced their joint venture in the sports streaming world, FuboTV is taking a stand. The streaming service is suing the companies over their plan to launch that unified sports streaming app. So with more on this, we bring in our Benjamin Schiller, who's going to explain what this lawsuit means. Hey, good afternoon, Ben.
Well, good afternoon to you too, Bradley. More chaos in the media industry. Fubo has launched a civil lawsuit against media giants including Disney, Fox, Warner Brothers Discovery. Fubo is accusing these legacy media brands of engaging in anti-competitive practices for the past couple of years. This comes after immediately these brands announced a joint sports streaming venture just last week or just earlier this year, which they intend to launch in August of this year exactly. The suit accuses these 3 companies of trying to suppress Fubo's market in sports streaming. Fubo, which launched in 2015, has been a prominent sports streaming platform for nearly the past decade. Today, Fubo has nearly 1.5 million subscribers. Fubo has monthly plans ranging from $33 to $100 Fubo is clearly concerned that its subscriber base will take a tumble this year. The new sports streaming service from these three companies, like I mentioned before, that the Fubo is suing, is expected to launch their sports streaming venture in August, just before the NFL preseason, guys.
So, Ben, there's a lot of different ways we could kind of attack this. I saw a lot of people online saying they hadn't even heard of Fubo before the Super Bowl, and then they had like those 2 or 3 commercials. But just talking about the stock and the markets, their shares have taken a tumble the past few days. How should Wall Street react to this lawsuit?
Well, it's taking a tumble for the last 2 months just in general. Just this week alone, since Tuesday, the stock is down 17%. It actually closed today at $1.77 per share. And in the past 2 months, the stock was at $3.60. Now it's down to half that percentage. Just in the last 6 weeks, the stock, guys, is down 36%.
Thanks, Ben. Great to have you on the show. And coming up, we'll break down how the markets are performing after a big week of earnings. Stick with us.
Entire bowl of nachos, but tonight he's earned that right because a few hours ago in the middle of happy hour he recognized a sign, not from the gods or a bolt of lightning, but from a double heart, a kissy face, and a fourth ha in ha ha ha. That's when Jordan knew he was buzzed. So when it was time to go, he got a ride home instead of driving. Be a legend like Jordan. Recognize your buzzed warning signs and get a ride home. Buzz driving is drunk driving.
Welcome back to Market Shares. We're about 14 minutes past the hour. Let's take a look at how our 3 indexes ended the week. We're going to start things off with the Dow once we get these numbers up. And the Dow up about 350 points this week, sitting at around 39,000. The NASDAQ up about 93 points this week, 16,000. And the S&P rounding us out 57 points. It's up this week, about 1%, sitting at about 5,000. All 3 indexes in the green, Peyton, and part of that is from NVIDIA, but part of it is also from these other movers that are propelling the major 3 indexes. Let's get to our market movers here.
Yeah, let's get right to our first one.
So Moderna, you would think that Moderna shares would actually be down. You would think their revenue would be down as the demand for COVID vaccines continues to decline. The vaccine, basically Moderna's only marketable product, but the world is moving on. But here's the thing. Moderna's earnings actually up based on deferred revenue. So basically, that's products that they've been paid up front for. They're paid in advance, and they will eventually get those products to the companies that they sold them to. But after the COVID surge, Moderna is kind of scaling back. They're focusing on cost cutting, which is a trend we've seen in the economy. But the company beating earnings based on its cost cutting and deferred revenue. Let's get to Intuitive Machines, Peyton.
Yeah, Bradley, this is a pretty cool story. So this is the first privately owned company to land on the moon. So they just landed the Odysseus lander, and it's on the lunar surface. They're starting to send data right now. But what does this mean for their stock? So the successful landing sent the stock rocketing. As you can see, they're up right there. And anytime there's a breakthrough with anything, as we're seeing kind of with chips right now with that NVIDIA skyrocketing right now.
Yeah.
Anytime there's a breakthrough, people get excited and they wanna buy. They see people are optimistic and they see something that nobody else is doing and they're gonna jump on that. So that's why that number is up right now.
You know what's incredible about Intuitive Machines is they went public on a SPAC about a year ago, and shares slowly slid to all-time lows near $2, and now they've ripped about 40% higher since January this year alone. That moon landing, also pretty incredible, the first one in over 50 years, Peyton. I mean, it seems like we're actually finally getting back into space exploration in this country. Let's talk about DoorDash to round things out here. The stock trending up this week on an upgrade from Morgan Stanley. So Morgan Stanley says it's time to buy, and that's why the stock is up. It's really simple as that, up about 9 points this week. And DoorDash, yeah, they beat earnings, but the stock fell after earnings because a lot of analysts thought, yeah, you know, DoorDash is probably not going to get much better. So a lot of people dumped it after they announced earnings, but Morgan Stanley, after they lost about 9%, they're saying, hey, it's a great time to buy.
Yeah, they're saying buy to overweight your portfolio. Apparently, they're selling right now at 121, but they think things are going to go up to the shares are going to go up to 145 next year. So stock went way down, but Morgan Stanley is saying buy right now.
It's going to be one to follow. DoorDash up about 100% in the last 12 months alone. After the break,
President Biden has announced a series of actions to strengthen the cybersecurity of America's ports. How this plan will change infrastructure after the break.
To an excellent episode of Live from Studio B.
Welcome back to Market Shares. The Biden administration says they'll be spending billions to build new cargo cranes at shipping ports.
yeah, they say these investments will address a possible threat to national security. Joining us now is our political analyst, Luke Radel. Luke, why is the White House concerned about these cranes? Seems like a pretty niche area.
Bradley and Peyton, officials at the Pentagon have been concerned for months about the possibility that China could be monitoring U.S. shipping operations through cranes manufactured in their country. Take a look at this video from the port of Oakland of one of those giant cargo cranes making its way into California from China, which some officials say these cranes could be used for spying on the U.S. Here's the head of the Port of Los Angeles giving a less than reassuring answer on this point to Bloomberg TV yesterday.
Chinese cranes spying on us.
They're collecting data. They're looking at information. 53% of the Port of Los Angeles businesses trade with China. What they're using that data for is the question.
Yeah, that's basically a yes then.
Yes it is. And look, since the COVID-19 pandemic, there have been bipartisan concerns about our over-reliance on China for everything from masks to microchips. But in this case, the cargo cranes built largely in China form the very foundation of our global economy. Installed in coastal ports, these giant cranes assist in shipping equipment from public and private entities. And the primary concern expressed by the White House is that military shipments could be monitored with surveillance equipment or halted in a cyber attack on software inside of these cranes.
So obviously protecting national security is a key priority, but with over $20 billion going towards increased port security, the question always is, where is this money coming from?
Yeah, Peyton, it's the right question to ask. The White House says these funds will be coming from the bipartisan infrastructure law that was passed in 2022. That has been a major accomplishment of the Biden-Harris team that they will likely run on in November. But it will be interesting to see, though, if they brag about this effort to counter China on the campaign's brand new TikTok account, since that app has also been the source for some concerns about the spying efforts of the Chinese government. Reporting this afternoon for Market Shares in studio, Luke Radel.
Thanks so much, Luke. Across the United States, companies are cutting costs and jobs in an effort to please shareholders and drive profits. Jacob Goldberg is in studio to talk about which companies are the biggest culprits and why they feel now is the best time to cut back.
Thanks, guys. So we're talking about job layoffs happening across the country, and really a lot of sectors of the economy are not safe. Let's get right into the numbers of these specific job layoffs. We saw 82,000 plus job layoffs in just January alone. That is actually a 136% increase from just a month before in December. But something to note is that 136% increase in December is a 20% decrease from December 22. So the economy did really well in 2023, and some of these jobs or some of these industries that overhired are now having to cut back. So let's look at some of the biggest companies cutting some job layoffs, and you can see that it really is all sectors. Mattel, they had one of the most popular movies of the year, and Barbie, they were very successful this year with revenue, but they're trying to please their shareholders and cutting some jobs. We see the financial sector with PayPal, some beauty companies with Estee Lauder, and then we see Levi and Nike, that's the fashion industry. So really, there's so many parts of the economy that are trying to cut their costs and get those shareholders happy. And now let's look at some of the numbers behind some of those sectors I talked about. We see financial industry cutting 22,000 plus jobs. In January, the tech industry right behind them at 15,000, and the food industry, which is more food manufacturers making food for grocery stores and restaurants, they cut over 6,000 jobs total. So what are some of the reasons for layoffs? Well, the main reason is artificial intelligence, and I'll get more into that later. But why hire someone when you can have artificial intelligence do their job for free? And that's what a lot of companies are seeing, especially with the increase in some artificial intelligence technology. Pandemic hiring binges, as I mentioned, the economy did really well. They hired more people last year, so now they're having to cut back on those hirings to try and make a profit. New labor contracts, we saw UPS get into a new labor contract with their employees. They're paying their employees more, so they don't have as much money to hire new employees. And interest rates, that's always going to be a factor in what companies are doing with their employees. And so let's look at a quote here about the AI I talked about earlier from Andy Challenger. He says, these layoffs are also driven by broader economic trends and a strategic shift towards increased automation and that AI adoption in various sectors. So in most cases, companies point to cost cutting as their main drivers for layoffs. There are still a lot of companies that are successful. I mentioned Nike cutting costs earlier, but they're actually super profitable and gave their shareholders some money back in dividends. So these companies are making a profit. They're just having to sacrifice those employees, sadly, as part of that reason for making a profit. But is there any good news I can give you on all these job layoffs? Is there any reason to be optimistic? Well, there certainly is. In January 2023, we actually added, or sorry, that's 2024, but we actually added 353,000 jobs. So I mentioned we cut over 80,000 jobs, but we added so many more. It's just some sectors are adding more than technology, which is losing. So it just depends on what industry you're in, if your job is going to be necessarily safe or in danger. And in December, 330,000 jobs once again, and then November, 183. So we've been steadily adding jobs to the economy, which is a great sign for many. And now another quote for this good news. Daniel Zhao, the lead economist at Glassdoor, says, this just reaffirms that the job market entering 2024 is on solid ground. So I might have scared you a little bit with some of those job layoffs, but don't worry, there's still plenty to be optimistic of going into the rest of this year. Guys, back to you.
Thanks so much, Jacob. Discover what's in your wallet. Capital One is buying out Discover. The deal has been considered earlier this week. If it goes through, it could make Capital One one of the biggest credit card companies in the world. Here to break it down, the Capital One and Discover merger is our market shares analyst, Peter Berry. Peter?
Peyton, Bradley, if you own a Discover credit card, you may soon have a Capital One credit card in your wallet. Capital One's purchase of Discover was announced on Monday. The all-stock transaction is valued at a staggering $35.3 billion. Two of the largest credit card companies in the nation would merge, giving Capital One the chance to surpass JP Morgan as the largest credit card company in loans and the third largest by purchase volume. This deal still has to win regulatory approval, though. Capital One has nearly $500 billion in assets. With the potential acquisition of Discover, it gives them access to over 300 million cardholders. The Capital One CEO, Richard Fairbank, had nothing but praise about this deal, saying, quote, "Our acquisition of Discover is a singular opportunity to bring together two very successful companies with complementary capabilities and franchises and to build a payments network that can compete with largest payments networks and payments companies." End quote. Discover CEO Michael Rhodes also liked the deal, saying it brings together two strong brands that will maximize values for shareholders. But the announcement was criticized by some U.S. senators who believe the merger could reduce competition and increase fees and costs for consumers. Massachusetts Senator Elizabeth Warren is already calling on the Office of the Comptroller of the Currency to reject the deal, which is a federal regulatory agency which must approve the transaction. Also, Ohio Senator Sherrod Brown is expected to take a closer look at the deal. Senator Brown is the chairman of the Senate Banking Committee and is up for re-election in November. The final approvals for the merger are not expected until later this year or early next year. Discover could possibly go to another buyer if it is blocked by the Federal Trade Commission. Then Capital One will have to pay a hefty fine of $1.4 billion for the breakup. And according to most Wall Street analysts, if enough opposition emerges, there is a deal that this chance might not happen at all. Peyton, Bradley, I'm going to send it back to you guys at the desk.
All right, Peter, thank you so much. One of the biggest stories of the week for sure. Yesterday, a massive outage knocked out cell phone service for thousands of AT&T users. What caused the outage after the break? I thought I just started reading the ticker.
Oh, you got it. You know, since I got rid of my car, I really enjoy walking.
Okay. God, no.
Getting pulled over for buzz driving could cost you around $10,000 in fines, legal fees, and increased insurance rates.
Oh, you're home early. You live with your mom?
That'll set your game back a few years. Buzzed, busted, and broke. Because buzz driving is drunk driving.
Welcome back to Market Shares. Many AT&T customers were left without cell phone service yesterday. A widespread outage impacted over 70,000 users and began early in the morning. The outage lasted roughly until 3 p.m.
Now the FBI has partnered with the cell phone carrier to investigate if there's any possibility of a cyber attack. But based on the initial review, the company thinks that the outage was caused by technical issues as they try to expand their coverage. Peyton, is this something you were affected by? Because it wasn't just AT&T, it was also Verizon and T-Mobile going down.
I didn't notice. I don't know if I was on my phone. You said you noticed though, correct?
I did, but it wasn't like early in the morning. It was more of like 11 a.m., like noonish. I go on my phone and I'm like, wait, I have no service. But I was home, I had my Wi-Fi, I was chilling.
Yeah, a lot of things that, you know, we think are for sure, like planes and cell phone service, are just kind of giving out on us recently.
It's kind of nice though when you kind of disconnect for a little bit and you just get to actually take in the world.
For sure, like a dopamine detox, not the constant scroll and then the pings. Yeah, it's definitely a nice break for
Sometimes it's what you need. But that's all the time we have for you on this episode of Market Shares. Be sure to follow us on Twitter and Instagram at CitrusTV News for more of the latest. I'm Bradley Hoppenstein.
And I'm Peyton Spellacy. Have a great night, Syracuse.